Welcome to Inside India. I'm JP Ong, and here are your headlines. The Indian markets coming off their worst week in 7 months as trade tensions continue to weigh on sentiment. The RBI kicks off its meeting today, where it's widely expected to keep rates steady. But is there a chance of a surprise cut? Nomura thinks we could see one. We'll hear from them later on in the broadcast. And Tata Capital announcing the price band for its $1.8 billion IPO in what could rank as one of India's largest listings. Good morning and happy Monday. We'll take a look at how Asian markets are trading at the start of the new trading week. And a happy Monday it is for most of the major bourses across the region. You're seeing the Nikkei 225, though, standing out with an intraday loss, but easily explained by the fact that a number of Japanese companies listed in Tokyo have gone ex-dividend today, which is pulling down and weighing on the Nikkei 225. A good day for the South Korean Kospi, up by 1.3% on hopes that tax reforms might mean less taxes on dividend income, which is boosting the outlook, that is, for equities out in Seoul. Meanwhile, you're also seeing a good day for the Hang Seng Index, trading about 1.5% in the green, and the Shanghai Composite just waking up today, but waking up on the right side of bed. They're up by about 0.2%. After a barrage of new tariff announcements last Friday, President Trump is reportedly considering new restrictions on electronic devices. Sources telling Reuters that the U.S. government could impose tariffs based on how many chips a device has, with one source suggesting a 25% tariff on chip parts inside devices and 15% on any electronics from Japan and Europe. These new duties could apply to a huge range of goods, from laptops and televisions to even toothbrushes, driving up the prices for the American consumer. White House spokesperson Kush Desai defended the move in a statement. America, quote, cannot be reliant on foreign imports for products essential to national and economic security. The Indian market's also set to come online in about 43 minutes to start off the week. And here's what Gift Nifty futures are now showing us in today's session. Keep in mind that they are coming off one of the biggest losing streaks, longest losing streaks in about 7 months. And so far, Gift Nifty futures are again foreshadowing that we might see an intraday gain. But again, it's done that for the better part of the last week and a half, actually, only to close out the day and fumble into the red. And thus also perhaps just indicating that a sentiment out, at least among traders in Mumbai, indeed has become a lot more cautious and risk off. We are seeing again that the Indian rupee in today's session is looking a bit unchanged, but keep in mind it's also been testing its weakest levels on record over the last couple of weeks. And also this coming as the Reserve Bank of India is set to make their policy decision, with a lot of decisions, at least with some expecting that perhaps there might be room to keep policy intact and unchanged, which might be giving them just a little bit more of a firmer ground this Monday morning. We're watching out for India's industrial output figures due to be released later on today. And that also perhaps just factoring into how things are trading so far. But going back to the Reserve Bank of India, which kicks off its policy meeting today, a Reuters poll shows economists expecting the central bank to hold rates steady at about 5.5%, with inflation projected to remain benign and amidst hopes of a strong GDP print. If the RBI does hold, it would mark a second straight pause this year. The repo rate has already been cut by about 100 basis points since February. CNBC TV18's Latha Venkatesh joins us now. Latha, this is a very important day, of course, and a very important meeting. What are you watching out for when the RBI policymakers decide to convene later on today?
Well, one is waiting for the rate cut decision or a pause decision. The meeting starts today and ends on Wednesday, so we will get to know the decision on Wednesday, October 1st. The street is split right down the middle, with about 60% expecting a pause and 40% expecting a rate cut. There are good reasons for a rate cut because inflation is considerably lower. The inflation for the full year is expected to go to 2.4. The Reserve Bank's current expectation average for the year is 3.1, and the street has now lowered it because there have been indirect tax cuts, GST tax cuts, plus food inflation is undershooting the Reserve Bank's forecast. Therefore, the average inflation may also be lowered by the Reserve Bank. That's one number the street will very closely watch. What is their inflation forecast? Also, what is their growth forecast? Because growth has been surprising on the upside. So the street is divided. If growth is doing good, will they cut now? Will they keep an insurance cut? Or will they give the cut now because of the adverse sentimental impact of the US tariffs, as well because inflation is giving you space?
Well, So inflation, of course, is central because that is the primary mandate for the Reserve Bank of India. But Latha, I'm sure that they're also looking at the rupee, which has, as we mentioned,
Yes.
tested its weakest levels on record on a number of occasions in the last couple of weeks. What are the expectations from the RBI now on the currency front, and if there is any commentary that they might issue with regards to that rupee weakness that we've seen?
Well, usually the Reserve Bank doesn't speak much on the currency. They will mostly only tell you that the rupee is a market-determined exchange rate, and the Reserve Bank intervenes only to smooth out volatilities. Sometimes it may allow slightly larger volatility, sometimes it may allow slightly low volatility, but it always allows the rupee to find its own level in the market. So unlikely that they will say too much, except that, the country's current account deficit is lower than the long-term average, and, the internal, in terms of growth, it is the fastest growing large economy in the world, and therefore foreign investors will come when they see value. I don't think they will say much. The doubt that the market has is whether in the face of a falling currency, the Reserve Bank will cut. My sense is that will not weigh very heavily on the Reserve Bank because the Indian market doesn't attract capital flows because of interest rate differentials. It attracts capital flows because it is a growth economy, and growth gets a leg up if the Reserve Bank cuts. So the rupee's fall is not a very big reason why the Reserve Bank will not cut.
Yeah, it's at 88.65 against the US dollar right now. But as long as the Reserve Bank of India doesn't seem as worried, perhaps that might give markets and investors a bit more room to actually breathe and perhaps be a little bit more relieved for the time being. That's Latha Venkatesh from CNBC TV 18. Thank you so much for your update, and we'll see what the Reserve Bank of India does in the next 2 days. And Sonal Verma is the chief economist of India and Asia, and ex-Japan, that is, at Nomura. She's here to talk to us about what their expectations are with regards to this very important meeting that will happen, that will culminate with a decision in the next 48 hours. Sonal, thank you so much for joining us today. Nomura is one of the houses that's actually expecting that the Reserve Bank of India, or the RBI, might trim rates in the next 2 days, actually. Why do you think that is the case, ma'am?
For a number of reasons, JP. One, even excluding the GST cuts, inflation's tracking closer to 2.5%, and underlying inflation measures have been at 3% for nearly 2 years now. So real rates are quite high, and that gives the space. Second, there's this cross-current between the expected boost from GST versus the drag from tariff. Our own assessment is the drag from tariffs will more than offset the short-term boost from GST cuts, and most of this impact will be seen after October. So the forward-looking growth trajectory does not look as rosy as the backward-looking data is. And third, in terms of timing, India is now in what is the festive season and also the busy credit season. So while the government is giving some boost to consumption from the GST cuts, this is actually the time to cut rates because the peak of the credit boost is going to happen now starting October. So waiting until December or later actually misses this crucial period when credit offtake happens. So all considered, we think there's both space as well as a need to cut rates.
Now, Sonal, this decision, though, it does have you and some of the economists watching India a bit more split, actually, as compared to other times. Why do you think there might be a case for them to hesitate right now? Because, as you mentioned, there are a number of factors that will give them room to cut rates. The fact that there are uncertainties with regards to tariffs, the fact that inflation is so benign, that also calls for perhaps maybe improving liquidity a bit in India. But why do you think some of your peers might be a bit more hesitant to actually call for a rate cut from the RBI right now?
I think the key rationale for the, on hold argument is to wait until perhaps December to see the impact of GST on consumption, how durable it is, and also whether India and US strike a trade deal in the next few months. If so, then the tariff impact could be more muted compared to the current fear. So there's this argument on wait and watch for more data on GST versus tariff and take a decision later. I think the second reason is really the RBI has not given any forward guidance. And And at the August meeting, their one-year forward inflation forecast at 4.9% was seen as a signal to suggest that the room for cuts was quite limited. So RBI was sort of overlooking the near-term undershoot and focusing on the one-year head overshoot. So I think that's the background in which there's this argument of RBI staying on hold. Now, since the August meeting, we've consistently again seen an undershoot on inflation. And as mentioned, even without the GST cut, the forward-looking inflation trajectory comes down by 40 to 50 basis points, given continued undershoot on demand-driven inflation as well as food-driven inflation. But yeah, there are arguments on both the sides that we are seeing right now.
So when you look at the argument also here that it might be a good time to cut because of the GST impact, the support for consumption, and also the fact that it's also festive season, it seems that the argument is that timing is of the essence and that you want to maximize the impact of GST and its possible boost for domestic consumption with a possible rate cut that will improve liquidity. Just what does this highlight about how important the Indian consumer is with regards to helping shield the economy from any of these externalities, such as tariffs, such as export issues? Just how important does this, how much is being pinned on the resilience and the strength of the Indian consumer right now, based on that argument that the time is now to cut to try and make sure that we can maximize GST and festive season?
I mean, it's very important in a number of ways. It's 60% of India's GDP. And therefore, the resilience and the offset that Indian consumption can provide against the headwinds from U.S. policies that span from goods to now even services, the importance of domestic consumption therefore becomes quite important. Also, when, for investment cycle in India to pick up more durably, which hasn't really happened so far, we need consumption to sustainably pick up. So this virtuous investment cycle pickup requires consumption to pick up. That's another reason for this to sustain. And within consumption, we have the, rural staple mass consumption categories vis-a-vis the more urban discretionary side of consumption categories. Before the GST cuts were announced, the rural side was doing relatively okay because of good monsoons, low inflation, whereas the urban consumption, which has been more impacted by slowing jobs and slowing salary growth, had been quite subdued. Now, into GST, there's been a big postponement of demand in anticipation of price cuts. And since the GST cuts have been announced on 22nd of September, there's been a pent-up increase in demand. Now, I think the crucial question is how much of this is going to sustain on its own because of price cuts vis-a-vis the more longer-term durable drivers of consumption, which is expectations of jobs, of income growth, salary growth going forward. So at this stage, our assessment is the GST cut is more of a short-term impact. And for a more durable pickup in consumption, we do need job creation to happen, which requires investment cycle to pick up. So the importance of monetary fiscal coordination, therefore, is quite important right now.
And I'm glad you highlighted some of the importance of making sure that job creation can be spurred and sustained out in India, because there are now concerns that perhaps unemployment in some areas of India are indeed starting to creep up in an unfavorable fashion. Also, if we start to see some of these H-1B visa restrictions start to bring more Indians back to India also, this could also exacerbate a labor market as well and perhaps competition for some of these jobs. So now, how important is it going to be to monitor for job losses from these tariffs, whether it be in the goods sector like the textile sector, or say some of the service sector like IT services right now? How important is this going to be with regards to the impact it'll have on the Indian economy overall?
I think a lot of these are more medium-term risks for the Indian economy in terms of the reliance of external sources of demand. So, for instance, the tariffs that have been imposed on India's goods sector currently at 50% basically strike at the heart of the job-intensive, labor-intensive MSME segments, which is the likes of textiles, gem and jewelry, marine products, just to name a few. So for these sectors, which are employment intensive, the impact on profit margins of exporters cash flow, reduces the ability of these exporters to actually, pay the workers on time. So we may not see a short-term impact on jobs because there's still hope that the tariffs will come down. But the ability to compensate the workers on the payroll will get limited. But the longer the tariffs stay, there are the employment spillovers in these goods intensive sectors as well. And second, the new development we've seen in terms of the H-1B visa hike. India does account for like over 70% of the H-1B visas issued. Now, IT companies have over the years reduced their reliance on H-1B visa issuance, and there could be more offshoring of jobs given the higher upfront visa fee, which will add to staff cost and margin pressure for IT companies. But that also increases the importance of creating more jobs domestically, even in the services sector. And IT companies are facing other challenges in terms of automation, the role of AI. So I think the big picture state for India is that the ability to rely on global factors to drive growth and job is receding, and therefore the importance of creating more domestic demand and creating jobs is extremely important right now.
Okay, so now very quickly, how much more room do you think the RBI actually has to cut rates? And if they get to that rate, what kind of impact might this have on inflation? Just very quickly, what might that scenario look like?
Well, we see the terminal rates in the cycle at 5%, so that's 50 basis point more in cumulative rate cuts from 5.5 currently. In terms of the longer term implication, I mean, the implication for 2026, we think growth should settle around 6.5% and inflation around 4%. So that's sort of the neutral setting that we see for 2026.
And perhaps something that India can tolerate as long as all the other factors like trade uncertainties might be tamed or perhaps created or perhaps a bit more assured, at least for the most part. So now, Pharma from Nomura, thank you so much for joining us today and for outlining why Nomura thinks that a rate cut might be in the cards over the next few days from the Reserve Bank of India. Well, keeping it with the GST cuts that came into force last week, it is the time of deals and offers in India's bazaars. As the festive season kicks off, here's what consumers and business owners on the ground are saying about the impact of those tax changes.
Our sale has increased a lot and it is going well from the start of Navratri. The effect of GST has been in place since September 22nd and our sales has increased by 15 to 20% since then.
It's very good because GST was very high, 18%, 20% on electronics. Now they have brought it down to 12%, 5%. So it's very good. So you save on every item, 2,000, 3,000. For middle class family, this is a big saving.
Very good. It is very good. It has a dual impact on my purchases, and my business will grow if consumerism grows. So it has a dual impact. There is no change for common people unless there is a GST cut on goods of daily use. There has been a reduction on big items, but you buy heavy goods such as electronics maybe once or twice in a year.
Well, coming up, companies from all across the world are eyeing the Indian markets as wealth and luxury spending grows in India. We'll talk about one such Japanese firm after a short break. Do stay with us. Welcome back to Inside India. Let's take a look at where the dollar index is trending today. And Dixie is looking a bit softer today and weakening to about 97.94, and thus benefiting currencies like the Japanese yen, which are also looking a bit firmer this Monday morning. That could also have something to do with the expectations with regards to inflation data in the U.S., with the U.S. core PCE price data on Friday showing the Fed's preferred inflation gauge little changed last month, rising 2.9% year-on-year and mostly in line with expectations. While the Fed targets 2% inflation, the numbers may do little to change the rate trajectory, with policymakers indicating at their last meeting they see 2 more quarter-point cuts this year. Fed fund futures are pricing in a 90% chance of a 25 basis point cut at the Fed's October meeting and another one in December. All eyes this week will turn to the other part of the Fed's dual mandate, the monthly jobs data. But the spending bill drama on Capitol Hill could throw a spanner in the works. Republican and Democrat leaders in Congress will be meeting with President Trump later today to discuss extending the government funding, which will run out by Tuesday and trigger a full government shutdown on Wednesday if no deal is reached. A shutdown would delay the release of the September payrolls data as well as a raft of other figures due this week. And if the Trump administration makes good on its threat to permanently lay off workers affected by the shutdown, that in turn would also affect the job numbers. Incidentally, that is also the day when Trump's latest tariffs on heavy trucks, pharmaceuticals, and furniture go into effect. Now let's turn our focus now onto Japan and the luxury space. Lin has been talking to a big name in watches, Seiko. Lin, what exactly did you both discuss when you actually had a chance to sit down with Seiko's leader?
I think the backdrop here, when we think about Seiko Group, right, is that it's had a very long and storied history. And traditionally, we remember Seiko as being able to provide sort of those affordable watches, but we're still with that Japanese quality, right? But over the last 5 to 7 years, what the company has been laser focused on is growing the premium side of things via Grand Seiko. So that was really the focus of the conversation with the president, Akio Naito, talking about the increase in terms of US sales of its premium brand. He says that over 5 years, it has increased by tenfold as well. And then I asked him about some of the other key markets, right? Because I think other than the US, the natural attention turns to China. And like many others in the luxury space, Akio Naito talks about the fact that it's been a difficult time. They did incorporate Grand Seiko Shanghai last year as well, but he says that they haven't seen the sales take off in the same way as it has in the US, that the property overhang is still there and is likely to last for some time. And therefore, then I guess attention turns to the other big market, right? 1.4 billion people in terms of India. And I asked him about that opportunity and how he's looking at that. Let's take a watch.
Well, actually, India for us is a rapidly growing market. And a week ago, we were having a group of Indian retailers who came to Tokyo to see the World Athletic Championship. And I was quite overwhelmed by the enthusiasm and passion of those Indian retailers who are so confident to increase their sales. So we are counting on the economical development of India, and India will soon become one of the top sales countries for us.
Is there a specific strategy for the mass market, which at the moment is still very, very price sensitive? Is there a price band that you're looking at that would work for the Grand Seiko brand, but doesn't dilute away from it either?
Of course, for us, the India market, Seiko is bigger in sales compared to Grand Seiko. But as the wealthy consumers increase in that country, I think there is a potential for us to grow with Grand Seiko. We have a subsidiary company, wholly owned subsidiary company in India with the experienced employees who are in charge of marketing and sales of our brands, both Grand Seiko and Seiko. And I think our strategy has been successful. And the country, the Indian consumers have become increasingly interested in Japan or Japanness, and the number of tourists coming from India to Japan is also increasing. So I think this is a momentum for us to communicate our brand story to the Indian consumers.
I also asked Akio Naito about how the company is looking at US tariffs. He said that since so-called reciprocal tariffs came into effect, that they've raised prices by somewhere between the 5 to 10% level, and he has not seen so far that US demand has dropped off either. I think what's really fascinating as well is that he was really keen to emphasize to me that whether we're talking about luxury watches, which is always associated with the dream, right? I mean, people who buy luxury is buying the dream, not a necessity. But even at that affordability level, the cheaper watches, his view is that people are buying the brand value, not because of the functional value specifically. And so when I asked him, are you going to onshore any of your manufacturing facilities? He's like, well, we can't because that's intrinsic. The Japanese style is intrinsic to our brand.
But moving from being an affordable, reliable brand into a luxury-related brand, that's quite an ambitious move though, isn't it, Lynn?
Absolutely, and they've seen some, obviously a big scale up here and a lot of success in terms of that move. It hasn't been easy, he says, but through word of mouth, through differentiation, through high-end retailers, they've been able to kind of really penetrate that market.
And a lot of interesting moves there. Lynn, thank you so much for bringing that to us. We will be right back after 2 minutes, but don't go away. Inside India will be coming back with more updates on the Indian and global markets. Stay tuned. Welcome back. You're watching Inside India, and here are some of the stories we're keeping tabs on as well. Dozens of people died and countless others are recovering from a fatal stampede in Tamil Nadu over the weekend. Popular Tamil actor Vijay held a political rally on a makeshift stage that attracted massive crowds from the region. Amongst those dead were women and children. Vijay's first meeting of his political party in October of last year drew similar crowds and had resulted in multiple casualties. In India's Union Territory of Ladakh, locals say they're struggling to access basic supplies amidst a curfew. The curfew was imposed after protests demanding statehood for the Himalayan region turned violent, leaving at least 5 people dead. The police have arrested prominent activist Sonam Wangchuk, who had been on a 14-day hunger strike. The Modi government accused Wangchuk of making provocative speeches. India clinched the Asia Cup 2025 title, defeating arch rivals Pakistan in a highly charged final. The match, played against a backdrop of political tensions, ended with an unusual twist, with Team India refusing to accept the trophy from Pakistan's Interior Minister Mohsin Naqvi, who also serves as chairman of the Asian Cricket Council. This was the third time the two sides faced off in the tournament, and each clash sparked its own controversy. Meantime, India slamming Pakistan at the UN General Assembly in New York. External Affairs Minister S. Jaishankar calling Islamabad, quote, the epicenter of global terrorism at the UNGA. Jaishankar mentioned the attack on tourists in India's Kashmir back in April that led to a military conflict between the two nations, saying that New Delhi exercised its right to defend its people.
Major international terrorist attacks are traced back to that one country. UN's designated lists of terrorists are replete with its nationals. The most recent example of cross-border barbarism was the murder of innocent tourists in Pahalgam in April this year. India exercised its right to defend its people against terrorism and brought its organizers and perpetrators to justice.
And without naming the United States, Jaishankar also spoke about tariffs, saying that de-risking has become a growing compulsion for countries facing tariff volatility and uncertain market access. We are counting down still to the market open in India this Monday, and this is how things are shaping up about 13 minutes before the opening bell. And as we wait for those figures to actually load, we have to remind our viewers that the Indian Nifty, that is on a 7-day losing streak, its longest losing streak actually in about 7 months. And a sharp contrast actually to the early September rally that pushed it above 25,000 points, with the rupee also looking quite soft and testing its weakest levels on record over the last couple of weeks. And of course, we'll take a look more at how exactly these the Nifty actually opens. Earlier on today, we did note that the GIFT Nifty futures were flashing a meager intraday increase, that is, or rise. But again, this was a similar story from most of the recent sessions where the Indian Nifty 50 actually closed in the red. Now, the latest on the trade front, U.S. trade negotiations have reportedly told their Indian counterparts that India must curb its purchases of Russian oil, which are a crucial part of these trade talks. Indian Commerce and Industry Minister Piyush Goyal visited the U.S. last week to meet U.S. Trade Representative Jameson Greer. A spokesperson from India's foreign ministry said the talks were constructive as officials discussed trade and tariffs. He also addressed America's hefty new fees on the H-1B visa.
With regard to H-1B, let me tell you, you are aware that Ministry and our embassy in Washington, D.C., they have been in active touch with the U.S. administration. You would have seen after those changes were announced, subsequent to that, clarifications and FAQs were issued by the U.S. side on as to how it's going to play out. This is still an evolving situation, and we remain engaged at various levels.
Meanwhile, U.S. tariffs on branded and patented pharmaceutical products kick in on Wednesday. India pharma companies mostly export generic drugs and are largely expected to escape the worst of the tariff impact. But analysts from the Global Trade and Research Initiative flagged uncertainty around language and categories. For example, paracetamol is exported both as a raw material and as a pill for certain brands. That uncertainty causing some jitters in the market on Friday, with the Nifty Pharma Index sliding about 2%. Nikhil Masurkar is the CEO of Entod Pharmaceuticals, and now he joins us today to talk about the sector and his company's own reactions to those surprising tariff proposals that were levied by the Trump administration in the latest sector that might be in the fire line of some of these trade uncertainties. Nikhil, thank you so much for joining us today. You know, markets had a bit of fright when the tariffs were actually announced, 100%, but some did point out that generics will mostly escape the ire of these tariffs. What has been the reaction from from some of your peers in the Indian pharmaceutical space, and yourself, though, as the CEO of Entod Pharmaceuticals, and what kind of exposure are we talking about to the U.S. market right now?
So thank you for having me on your show. So the 100% tariffs only apply to the patented and branded medicines. So the generic medicines, which is a majority of what India exports to the US are not part of the tariffs. So we don't expect any significant impact on the Indian pharma industry. In fact, it opens up the opportunities for diversifying exports out of India. So I think there's more opportunities here than anything negative. My own company, Entot Pharmaceuticals, I mean, we don't have any export business to the US. We've always focused on emerging markets and countries of the global south. So it wouldn't impact us, but I wouldn't expect it to impact the industry either.
Of course, as we've noticed from the Trump administration since the start of the year, Nikhil, sometimes things can change. Things can get expanded. Things can actually be revised. And there's always the possibility that one day either the American president or some of his advisors wake up and say, you know what, let's lump in some of these generics as well because we want some of this to get onshored back to the United States. Is there a concern that one day that this might be something that you'll have to prepare for, that the language is revised and it will include generic pharmaceuticals later on? Because we have seen that the goalposts have been moved by the U.S. with regards to tariffs in other sectors in just in the last couple of months. Is this a concern that you think the pharmaceutical industry needs to prepare for?
Well, I mean, let's hope that doesn't happen. But if it does extend to generic medicines, it wouldn't be a win-win for anyone. All that it would do is basically, increase the medicine prices in the US. The US insurance companies will be heavily impacted, and it could potentially lead to a collapse of the healthcare system in the US. Bear in mind, the US imports almost 50% of its generics from India. So I don't think that would happen. I think if anything, I think, that's something that the industry isn't expecting at this point of time. On the other hand, India has other opportunities as well. Like, for example, just a couple of days ago, I think China announced that their 30% import duty on Indian pharmaceuticals would be slashed. So that opens up a whole new market for India. So I very much doubt that the US would take on generics in the trade war.
Nikhil, how exposed is Entot Pharmaceuticals to the United States in terms of a source of revenue? Is it one of the major sources for Entot, or are you focusing on other markets as well? And how difficult is it for Indian pharma companies to diversify away from the United States as compared to, say, some of your counterparts in the textile industry, for instance?
So my own company, Entot Pharmaceuticals, doesn't have any exports to the US. As I mentioned earlier, our focus is more on Southeast Asia, the African markets, the Latin American markets. However, almost 30% of revenue from the Indian pharma industry, from the exports, comes from the US. But again, this is low-cost generic drugs. I think the industry would kind of be forced to diversify to supplying to Europe, to supplying to the African countries, to Southeast Asia. I don't think this kind of over-dependence on the US in the long term would be in the interest of the industry. So I think there would be active strategies in place by the top 40 pharma companies in India to move, if I could say, beyond the US.
And is it easier for Indian pharmaceuticals to diversify into new markets should the need arise, say, compared to other sectors like the textile industry, for instance? What exactly is the dynamics there with regards to diversifying? Is it easier or harder for the Indian pharma industry to do that if the need arise?
Well, it's definitely easier compared to the US scenario. For example, it would take the US several years to shift manufacturing out of India because of all the regulatory obligations. It's easier for India to diversify to countries that have semi-regulated markets, but with good emerging markets, rather than dealing with the regulatory hassles in the US. So very much possible for India to do that. And actually, it started already in the last 6 months when there was a bit of uncertainty about the tariffs. A lot of companies who I've been in touch with And many of my peers have already started taking steps to diversify their exports.
Nikhil, you mentioned a while ago that China might become one of possible market with potential for India with the reduction of some of those tariffs. I do wonder though, because it's also been noted that while India has one of the largest pharmaceutical industries in the world, or sectors in the world, a lot of the supply chains are dependent on pharmaceutical ingredients that actually come from China as well. And some argue that the pharmaceutical industry broadly might need to diversify the supply chains away from being that dependent on China, and perhaps even developing some of the ingredients more in India actually to help cement or perhaps even strengthen the industry. Do you share those sentiments, or do you think that's a risk that perhaps is secondary or tertiary in terms of having to be addressed?
So I think on one hand, I think with China having slashed its import duty on pharmaceuticals, I think the trade deficit could reduce. Right now, India relies on China for its APIs. I think it's as high as 70% dependency. However, that's reduced in the last few years because the Indian government has taken a lot of steps to boost API production and development in India. There are various schemes in place to do that. And I think in about 5 to 6 years, I think the scenario would change. I think we'll be more self-reliant when it comes to APIs here in India. However, I think having exports of pharmaceuticals to China would be good. It would be a win-win for trade between India and China. And I think that's the way forward, especially with the US being a bit of an uncertainty.
And Nikhil, I'm wondering if some of the tariffs, while it might not be keeping you and your peers in the pharmaceutical space up at night, do you think this might hurt overall investor sentiment with regards to how some of the listed pharmaceutical companies might actually perform at the moment? Is this something that might be more of a concern right now? Also, investor sentiment perhaps hitting the stocks of some of your peers.
Well, I think maybe in the short term, because what investors are looking for is certainty in the markets. They're looking for stability. They're looking for consistency. And with things not being that way, from the US, I think maybe in the short term, it could, create a bit of panic. But I think in the medium to long term, I think the industry here in India is very robust. We've shown resilience even during the COVID period. So, I don't think in the medium to long term it's going to have an effect, but maybe in the short term.
Okay, and we'll have to see if that indeed plays out, and hopefully there are no more curveballs thrown to the very important pharmaceutical sector out in India. Nikhil Masurkar from Entod Pharmaceuticals, we appreciate your thoughts and your sentiments with regards to the recent developments hitting this very important space out in India. Now we're counting down to the market open here in Mumbai, but we'll return in just about 2 minutes to bring you the latest and whether or not we might see the Nifty 50 breaking out of its recent slump. Back in 2 minutes, you're watching Inside India. About 90 seconds into the Monday market open out here in India, it's looking a bit more optimistic. It seems that Nifty futures were indeed somewhat right. They are opening marginally in the green and perhaps hinting at that 7-day losing streak coming to an end. They're up by about 0.8% at 24,690 points today. The Indian rupee, though, back to losing ways or back to weaker ways. 88.70 is where the local currency sits now against the US dollar. And of course, we also have gold and silver futures trading out there, also hitting a record high ahead of the RBI's decision. Of course, these precious metals also very important, not just because India is one of the biggest buyers of gold in the entire world, but also because of gold and silver's importance as a safe haven destination for global markets recently. And we're seeing perhaps a hit at the risk-off appetite, still having some flickers of life, actually, given the fact that those futures continue to track higher ahead of that very important decision from the Indian Central Bank. Now, HDFC Bank is facing new hurdles, with Dubai Financial Services Authority barring the bank from undertaking new clients or conducting business through its Dubai branch. The monetary watchdog says HDFC had violated local rules. It had concerns over the bank's onboarding practices. HDFC had previously come under fire from investors for its role in the mis-selling of complex financial instruments. Shares now down by about 0.5% in the first few minutes of trading out in India to about 940 rupees apiece. Tata Group's much-awaited IPO of Tata Capital is finally here, with retail subscriptions open next week for the country's biggest issue of the year so far. 210 million new shares will be on offer, while existing shareholders will offload another 266 million. Bidding for institutional and anchor investors begins this Friday, with a price band for the $1.8 billion IPO set between 310 and 326 rupees per share. Now, Daniel Lam is the head of equity strategy at Standard Chartered Wealth Solutions. He joins us now to talk about whether or not about the recent the struggles that the Indian equity markets indeed has faced and how Standard Chartered is viewing these. Daniel, thank you so much for joining us today. You know, we've seen quite a dramatic September September to remember, as some would say, for the Nifty 50. At one point, it actually breached 25,000, and now it's at its longest losing streak in about 7 months. As a foreign investor who looks at India, what do you think has been behind the sudden change of appetite towards these markets, especially from foreign investors that have sort of kept Indian markets at a relative arm's length for most of this year?
Well, thank you. Thank you for inviting me. So for Indian market, it's really a sum of a few factors. Okay, so first of all, you have Donald Trump, all his tariff announcement about India. Also, Chinese equities, they've been doing very well. And of course, China and India, within the EM, they are competing for foreign money inflows. And of course, the valuation of Indian companies have been relatively more expensive than the Chinese companies. And now with the trade war looking at somewhat more under control between US and China, and the Chinese equities looking cheap, foreign investors have been favoring Chinese equities this year over Indian ones. That's the reason.
I find that interesting, though, Daniel, because you're not the first person to actually point out that Indian stocks might just simply be too pricey at the moment. But we did have a guest from Allianz make the case that price-to-book ratios in India relative to the MSCI All World are near a 15-year low. It could be a buying opportunity. Do you share the same sentiments with regards to whether or not they are less pricey now, or do you still think that perhaps valuations might be a bit still too rich for Standard Chartered to make a big position out in India right now?
Well, so we have a core holding of Indian equities. So basically that means that we're neutral India within Asia ex Japan, which we're overweight on. So basically at this moment in time, we do see the long-term structural story intact for India. But at this moment in time, it is a short-term flow that is dictating things. So the factors, like I said before, people getting tactical and going for Chinese equities, that's still intact. But having said that, India economy versus Chinese economy is not the same, right? Indian economy is much more domestically driven than Chinese economy. So the fact that Trump's announcement about the H-1B visas, yes, that can hurt IT sector, but in terms of the stimulus that the Indian government can put in, they can help things a lot. In fact, I would argue that the stimulus that the Indian government put in could be more effective than the Chinese ones if they want to stimulate domestic demand, because of the fact that Indian economy is much more geared towards domestic orientation. Okay, so in my view, it is a buying opportunity if it dips further.
Okay.
For the long term.
So I'm glad you brought up also some of these structural reforms and perhaps some of the stimulus that's been introduced, because there's also been structural reforms introduced by market regulators out in India to try and liberalize or perhaps stimulate the IPO pipeline, which it seems to be working based on what we've seen over the last few weeks, to making listings a bit more easy to come by. Is this giving foreign investors like yourself perhaps hope, or perhaps a bit more optimism that sooner or later there might be a case to go back into these Indian markets based on some of the structural reforms that the capital markets regulators have been trying to introduce recently?
Yes, they have been very timely, right? All these reforms are coming at the right time, are coming at the right pace and strength, so to speak. So yes, in the short term, the noises will still be there, but in the long term, we believe that ultimately this is a good buying opportunity. I would say that the Nifty around these levels would be, investors can be getting a bit in. You can divide it into tranches and get in a little bit here and then get in more at around 24,000 levels.
So just being strategic there. Daniel, let's talk about some of the tariffs that you identified as being the thing that really perhaps stimulated or stoked this about face in terms of investor sentiment. Now, with regards to, say, the H-1B visas on IT services and the pharmaceutical sector, we had a guest just about 10 minutes ago speak to us. They actually think that these were knee-jerk reactions because the H-1B visas will impact American tech companies more, and the pharmaceutical companies, because they're mostly in the generic space, which are exempted, won't really have anything to worry about. Do you think that perhaps there were a few knee-jerk reactions that stoked some of the sell-offs in some of these sectors that maybe perhaps were a bit overdone, or do you think there's a reason for being a bit more cautious about these sectors now?
Well, the knee-jerk reaction, that's a very good term because that's basically the theme of the year. We've seen that from Liberation Day already across the whole globe, right? Knee-jerk reaction. Trump's negotiation tactics have always been the same, right? He's always trying to overstate and then try to get people to come to the middle of where he actually wants it to be. So I believe that this will be the case for India also, right? There's a knee-jerk reaction. People do panic when they hear such news, especially when you see lofty valuations. They said that, this is too expensive. Let's get out. Let's lock in some profit and then wait and see. So we are in the wait and see mode right now. That's why you're seeing the market drifting down instead of dumping down. It's drifting down a bit. Okay, so that's healthy correction. In terms of the sectors, at this moment in time, because we believe that the Indian economy is domestically driven and the stimulus measures coming in to stimulate the economy domestically, that consumption play and financials are the ones that we are favoring upon. But the tech sector, at a lower level, yes, it can look interesting also.
All right. So, Daniel, final question here. Since you said that knee-jerk reactions, it seems to have been the theme of the year, but at some point, people might think it's like the boy who cried wolf, right? Like it's another knee-jerk reaction. I'm not going to succumb to that. How seriously should we take these knee-jerk reactions? Because at some point, perhaps one of them actually merits the reaction that it's jerking at the moment. How are you playing out, or how are you trying to manage volatility when there's been so many knee-jerk reactions this year so far?
So yes, because of the knee-jerk reaction, we have been overweight. We are overweight on gold, and we are also looking at alternative assets because this year you do need to diversify your portfolio. You cannot park everything in one asset class. You cannot park everything into one region. That's very important, right? Because there can be times when one asset class can suddenly dump down, and you need other asset class to perform and to diversify.
All right, Daniel. It seems that that's the best we can do when there's been a lot of knees being jerked around in the markets at the moment. It seems it troubles even investors like yourselves. Daniel Lam from Standard Chartered Wealth Solutions. Thank you so much for the very sober and salient outlook on the Indian markets and the recent volatility we've seen hitting global markets overall. We thank you for your thoughts. That's Daniel Lam from Standard Chartered Wealth Solutions. And that's all the time we also have today on Inside India. But do keep watching CNBC because Access Middle East is up next. Have a good morning.